The stock market powered up new all-time highs as earnings grew 23.5% in the second quarter and sales grew a very strong 9.2%. We also had a trade agreement with Mexico, which sets us up for an agreement with Canada and probably with Europe in the near future, which will allow us to put more pressure on China. So we are less worried about a China trade war, and I think this has also given the stock market some boost. Hi, my name is David Wilson. I'm founder and president of True North Retirement Advisors, where we specialize in retirement planning for business owners. Looking ahead, for all of 2018, we expect very strong earnings and sales growth for the S&P 500 index. We expect over 20% earnings growth and over 8% sales growth for the year, which are both tremendous. And as we look into 2019, we see earnings growing over 10% and sales over 5%. And you combine that with consumer sentiment, which is now the second highest reading since 2004, that really sets the market up to continue to grow at a very strong pace. In addition to the strong sales and earnings and the sentiment, we also have the latest GDP Now estimates by the Atlanta Fed is 4.4% for the third quarter. So those are excellent numbers. I mean, nobody thought we could get to 3% GDP growth, and now we're talking about 4% for maybe another quarter. But the biggest news, and the thing that really makes us excited about the stock market at this time, is the fact that the consumer inflation numbers, the CPI, came in at 0.2% for August. That was below July. That put us on a track for the year of inflation of 2.7% instead of 2.9%. So you combine low inflation with strong economic growth, and that sets us up for the Goldilocks Scenario, which is a strong economy and a strong stock market. Also helping stocks is the fact that over the last 20 years, about half of the stock that was out in the marketplace has shrunk, has disappeared. And that's occurred because companies were bought out, they merged, and so back in 1998, the Wilshire 5000 index had over 7,500 companies. Now it's less than half of that, and so this helps in terms of you've got demand for stock, but you've got a shrinking supply. You add to that companies are going to buy back $1 trillion worth of stock this year, and you can see what could really provide the stock market with continued strength. So you have to ask yourself, what could overturn the Applecart? You know, obviously a full-blown trade war with China, but just today we slapped 10% tariffs on $200 billion of Chinese goods, and the market went up over 100 points. So obviously that's not affecting things like people might think. It could be a financial crisis like in Turkey or in Argentina. Obviously that's always possible. What's going to determine how long this lasts is how long the economy grows. I don't want to look ahead too far. All I want to say is I think if you're prudent and you want to manage your portfolio conservatively, I think the way to do it is you use strength, like now we're hitting all-time highs, to maybe reduce your allocation in stocks. In other words, if you're supposed to be at 50% stocks and 50% fixed income, and you're at 55% because the stock market has gone up so much, fine. Pull back that 5%. That's the smart way to manage your portfolio, and that's the way to be prudent in this environment.
Thanks for watching. If you're watching on YouTube, please like, comment, subscribe to our channel. We're ramping this up and we're putting out videos every week, and we hope to do that going forward. Also, if you have questions about your specific situations, your portfolio, you want to know if you're well positioned for this current market and economic environment that we're in, click on the link below to schedule your free 15-minute portfolio strategy call. Hold on, before you move on, can you say China like Donald Trump says China?
How does he say China?
China.
China.